what fucked his whole theory, and it really damaged the U.S. economy. And you want to talk about wealth inequality and wage stagnation? That's the guy, Art Laffer. His theory is what caused the wage gap and caused the damage to our economy. So, Lacey, how it was really tough for us because that's when the wage gap was really widening. It started in the 80s. And by the time we got to college and shit, we were in a recession and everything was tough. And it's like you could get a job, but it didn't cover your cost of living and stuff. Art Laffer and Alan Greenspan under Ronald Reagan. That's what caused that tax bracket and that thing when they allowed the rich to get richer without having to pay more. And it deregulated the government so much that, minimum wage was stagnant and nothing happened. This is the guy. This is one of the guys. It's one of the brain children, and this is who Trump wants in charge of the Federal Reserve.
Yeah, be afraid, people. Be very, very afraid.
So, let's do this. So, he's going to talk about the Fed here.
And, it's obvious that there's a difference between the executive branch and the Fed. And, it's going to go on as long as the Fed's independent. You're going to get these clashes, and always have had them, by the way. When I was in the White House in 1970, 71, 72, Nixon had this real big problem with Arthur Burns all the time.
That was weird. You there?
Yeah, you froze again.
Somebody tried to call on this line. I don't know how they got that.
That's what goes on there. And,
do you not think credibility in the US dollar and US government debt would be hurt if there was not an independent central bank?
Well, there might be. It might be. I mean, that's true. I mean, is it hurt by not having independent fiscal policy? Probably. I mean, they probably raise taxes way too much and spend way too much. If it were independent, they probably would spend less and tax less, which would make me happy. But I don't think that's the essence of what democracy is. I mean, I don't think an independent Fed run by academics.
So this is where he's so stupid on this. So let me explain this, kids. The Federal Reserve is a central bank. We were one of the last countries to get one. And we didn't do it like 1917. The British had been doing it, almost a century earlier. So what happens is this. The government of a country, like the United States, whatever, has a central bank. And that bank has one job. And that job, well, it basically has one client, which is the government. So it's a private bank, but it works for the government and is responsible to the government. And in our case, the guys who run it are appointed by the government that run the board. But the bank itself is private. And it's only allowed the one client, the United States government. Now, in that system, it has 12 other central banks that it uses in different locations around the country and regions. And what happens is they set things like the rate price on interest rates for bonds, for the U.S. Treasury bonds, because those are the risk-free ones because they're backed by taxes. So you're guaranteed to get your money back and with interest on a U.S. bond. The U.S. never fails to pay those. So they issue those out, or they can buy them back and put more cash back into the system if they want the system, people to spend more and they want inflation to go up, or they want the system to get hotter. If they wanted to cool it down, they buy back more bonds and release less cash, so there's less cash in the system. They sell more bonds and release less cash, so there's less cash in the system, and try to cool inflation that way. That's one way they do it. The other way they do it is they can move the discount rate. The discount rate is the rate at which banks can loan money. So if I'm the central bank and Lacey's buying a car, right? And I say, I'm going to set the discount rate at 1%, right? What that means is the next bank, let's say here, the next central bank with my guy Grogu. So Grogu's bank can loan money, right, out to people. So he can loan $100, but he has to have at least $1 in reserve to cover it. So he can loan it 100 times what he has. But this regulates it so people don't over loan, because banks used to loan out money they didn't have. And it caused recession after recession back in the late 1800s. So that's what he does. So I've just regulated, you can't go more than that, buddy. You can't leverage beyond that. Well, then the next bank can do the same thing, and the next bank can do the same thing. And so they can leverage all this cash that's just on paper for the most part. And that affects the rate that Lacey's going to pay and whether or not she can get the loan, is the availability of the loan. Because if I raise it to 10%, there's less loans that we can give it out because they've got to keep more cash in reserve to cover potential losses and defaults on loans. Right, so that's one. Those are just a couple things. So that's what the Fed does. But the Fed's ultimate goal is to try and keep inflation level. Usually they want about 2%. 2 to 3 is usually ideal. But 2% is like the sweet spot, for at least for now, for our country. And they want to keep unemployment as low as possible. So that's the two jobs of the Fed. But they're independent from the government. They report to the government, but they don't take orders from the government. And the reason that it's set up that way is because if they had to report to the government and they were a political institution, Lacey is running for office and she's the president or whatever, Speaker of the House, doesn't matter. And right now the economy's not doing really good, right? And inflation's fairly high. But Lacey's like, well, I wanted the economy to do better. I want to heat it up. So she can go to the Fed and go, well, look, I'm running for re-election and I'm running on a bad economy. So I need you guys to pump more cash into the system and heat up the economy. Right? So the economy looks better by the time we get to the election. And it looks like I did my job. But it's artificial the way it happened. And what ends up happening is if you're doing that in an already hot economy, you're driving inflation through the roof. And so Lacey gets reelected and then the economy completely tanks because inflation is way too high. And that's happened in every country where they don't have a central bank that's independent, like the Fed. Every country that's done it that way has fucked it. And that's what he's proposing, is that we don't let them be independent. So here, just to prove my point, in case you guys don't believe me, his proposal is to do this. So this is the IMF. And central bank accountability, transparency, independence, transparency. They talk about the Bank of England. So as a private company, its independence from government was not then correlated. They're talking about the Bank of England. So the legal basis, numerous studies have validated the importance of central banks' independence. Indeed, research based on IMF's database of central bank legislation shows that most nations' central bank laws contain anchors in one form or another for central bank independence. Generally, the laws tend to recognize that if politicians manipulate money policy to bolster their pre-election popularity, like I just said, the prioritization for short-term political gains could invite long-term pain for the economy in the form of higher inflation or even hyperinflation. And if you guys should check out this article if you're interested in it, because they cite examples of when it's happened in the past at other countries that made their Fed political. But that's what Art Laffer is suggesting. Now, will he be Fed chair? I don't know. He's fucking dirt old. I doubt it. I doubt he'll take the job. But that's the kind of guy Trump wants to put in there. That's the kind of guy Trump was taking advice from. A guy who tanked the economy.